Learning Objective 19-2 is to understand financial reporting rules for not-for-profit colleges and universities. And this can be a little confusing because there are a lot of different kinds of colleges and universities. And we'll talk in a moment about how those are going to be split up. In fact, let's skip over that right now. So for public colleges and universities, GASB, that's all going to follow GASB. And because these are basically an extension of the government. And it's GASB 35 actually that says that public colleges and universities follow governmental accounting rules. So these would be considered special purpose governmental entities, but they're engaged in business type activities and therefore they're really enterprise funds. That's because the tuition paid by students is meant to cover most of the cost of the services that are being provided. So these are in essence enterprise funds, and therefore the accounting is going to be very, very similar to FASB accounting. And again, they've got to be included as component units of the state government. Private colleges and universities, on the other hand, are going to fall under the FASB. And now you may also have, you have for-profit and not-for-profit colleges and universities. For-profit are going to be like regular companies. So I don't know if you ever heard of University of Phoenix. That's an example of a for-profit university. And they're going to just use regular FASB, GAAP, revenues minus expenses equals net income. Not-for-profit entities that are private, like Seton Hall, are going to fall under the regular FASB rules for private colleges and universities. And they're going to issue a statement of financial position, statement of activities, and statement of cash flows. They don't necessarily have to use fund accounting, but they usually do. So we have this really nice chart here, and there's also one printed in your notes that goes over four different types of four types of colleges and universities. You would have engaged in business type activities, and this is 98% of public colleges would be considered governmental entities engaged in business type activities, and they're going to be like an enterprise fund. So that falls under the GASB. It should use fund accounting just like any other governmental entity. And it's going to be combined with the state or local government, whoever it is who's responsible for it. Now, there is another type of governmental public college that actually has the ability to tax. And this is a special type of community college. I do not think that New Jersey community colleges fall into this category. But some community colleges do, in which case they would also need to have governmental funds. So they most likely would have some enterprise funds and then some governmental funds too. Private entities would be split into two categories, not-for-profit and for-profit. So not-for-profit is like Seton Hall. So you would use FASB accounting for not-for-profit organizations. And again, you're going to have with donor restrictions and without donor restrictions. And the three basic financial statements again: financial position, statement of activity, statement of cash flows. For-profits are going to be like companies. So something like University of Phoenix would be a for-profit university, and therefore it's going to just use regular commercial accounting. Now, there are a few quirks to university accounting, college and university accounting. One of them is that tuition is recorded as revenue at full rate. So it happens to be that in a lot of colleges and universities, most students don't pay full tuition, because typically what would happen is they get accepted to the school and then they get what's called a university scholarship. Now, sometimes they may get outside scholarships, or they may get scholarships that are funded from endowment. But oftentimes what they'll do is they'll just get what's called a university scholarship, and that would be a certain percentage of tuition or a certain dollar amount, like $10,000 a year. So oftentimes when students get accepted, they're told you have a $10,000 annual scholarship for 4 years. So the way you would record that is gross. Tuition would be recorded at full standard rate, and then you would deduct from it the amount of the scholarship. And almost all scholarships are recorded this way. You may have different kinds of scholarships. You have what's called fellowship, tuition and fee remission, things like that. For example, I'm an employee, and we have what's called tuition remission. So the way it works is most Seton Hall employees have an employee benefit that their children can attend Seton Hall with zero tuition. We do have to pay fees. So the way you would account for this is that revenue would be at the full tuition rate, and then you'd have a full deduction for the tuition remission that would go against that, and they would both appear in the income statement. Now, sometimes there's also work study. Work study would also be deducted from revenue, but as a separate item, because it's really an expense, because in theory I shouldn't say in theory, I'm sorry, the student is providing a valuable service to the university. That means you, Joa. Tuition and fee reimbursements for withdrawals also count as a reduction in revenue. So for example, if you have a student who starts the semester and gives money, pays full tuition, and then 2 weeks into the semester drops out and gets their tuition money back, then you would still report it gross. Revenue would be at gross less the tuition reimbursement for withdrawal. Usually academic terms, the main terms fall within a single fiscal period. So I think Seton Hall's fiscal year end is June 30th. And we have a fall and a spring, and they both occur within a full year. So you don't have a cutoff. You do have a cutoff problem with summer school. So what you would do is you would account for this as revenue in the term where it's predominantly conducted. But if you have it where what the National Association of College and University Business Officers, that's what that stands for, believe it or not, I know it, what they recommend is that you proportion the income between the two periods. And that's pretty much what everybody does. I believe that's what Seton Hall does. So if someone takes summer classes start in the middle of May and they end in the middle of August. That spans over the fiscal year end of June 30th. So what you would do is you would allocate that revenue and the related expenses to the 2 years. You also have something called board designated funds. And what the board can do is it sometimes will say, well, we have this extra money. We want to set it aside for this purpose. That is not a donor restriction, okay? And this is another CPA exam question. ASC 958 is very clear that a donor restriction is when a donor gives money to the university or college and says you can only use this for X, Y, for this. When the board says we have an extra $1 million, we want to save this for a certain building project, that is a board designated fund, you can set it aside, but it's not a donor restriction, and that's a very important point. And now I'd like to walk you through, this is in my notes. I shouldn't really call them my notes, they're really the textbook notes because they're all stolen from the textbook. This is some financial statements for South City College. So even though it's called City College, this is a private college. And here you can see a statement of financial position, in essence the balance sheet, and you can see that we listed all of the assets and liabilities. And then net assets is again split into two areas, with donor restriction and without donor restriction. Actually, I'm saying it in the wrong order. Without goes first because that's what you can use, and with means, you kind of have to forget about that. And what you would do is with donor restriction is here you would need to list in your notes what the donor restrictions are, as I think I mentioned before. So the notes would say which assets have donor restrictions on them and what the nature of those assets are and what the nature of the restrictions are. I'm trying to figure out what they are. They're probably the investments at fair value. Here's a statement of activities. It's probably a little hard to see, but it's in your book, figure 19-3. And you can see that this is like an income statement, but it's not. We don't call it income, we call it change in net assets. It's right down here in the bottom. And you have three columns. You have without donor restrictions and with. That distinction is very important. And it tells you that without donor restrictions, we had a $73,000 negative reduction in net assets, which is commonly referred to as a deficit. And with donor restrictions, you had what would commonly be called a surplus of $1,596,000. And why would you have a deficit in one and a surplus in the other? Because the purpose of the donor restriction is oftentimes to set assets aside to make money, namely the endowment. So if you look, the contributions are all with donor restrictions, so those obviously increase your change in net assets. And then when the program use restrictions are taken out, they come out of that column and they go into this, just like I did my journal entry before. So I'm subtracting 601 from with donor restrictions and putting it into without, because we did whatever we had to do to satisfy the donor restrictions. So you can see that right there. And then, let me make this a little bigger so it's clear. We also received some assets that needed to be restricted for some reason. And so this would be 101,000 that was taken out of without and put into with. Now you may also have endowments with a term. In other words, the money goes into the endowment fund, and the donor says to stay in the endowment fund to 10 years, and then you can spend it. Very, very common. So when the 10 years is up, it can come out of with and go into without. So you can see the various activities that are going on here. Very important is auxiliary enterprise, because this is the other things they do to make money. So colleges, Seton Hall doesn't do so much of this, but for example, selling tickets at basketball games, it's not really tuition, you know. Anyway, one thing which I'm not thrilled about how they're doing this is that this is a single-step income statement, and they're presenting scholarships and fellowships all the way down here. What I've seen is that they'll present tuition and revenues fees at top, and then they'll subtract scholarships and fellowships immediately. So you have a three-step income statement. This is only, it's really a one-step income statement here. I saw you usually have 2 or 3 steps in this. But this is what the income statement looks like, and this is what the statement of cash flows is going to look like. You have operating, investing, and financing. And you start off with operating would be change in net assets, which is like income. It doesn't need to be split into donor restricted and donor and with and without. I should really start saying without and with. But you can see here it's pretty much the same thing that you would do it with a for-profit. Investing and financing, the categories are very similar to a for-profit.